After shooting up more than 50% since January lows, does it still make sense to buy Tesla stock? With a PE ratio of 45.35x and a price to free cash flow ratio of 126x seems to be way overvalued, but how about the other metrics? Is Tesla a good business or is it a fable? We'll be taking a look at all this juicy details, so stay tuned with the Finance Dude. Hey dudes and duderinas, this is the Finance Dude. Welcome to one of the most complete and exhaustive stock analysis on YouTube. Since this is a new channel, you can watch how my stock picking strategy works in full detail by clicking on the videos on the top right. I'm excited to present my first coverage of a stock. I'd like to remember you that my goal is to analyze every single stock in the Russell 3000 and Stocks Europe 600 indexes. Massive, I know, but plenty of reasons for you to stay by my side and, together, we will make this easier and help to improve the world's financial literacy. That's my ultimate goal. In this episode, we have two missions. First, assess whether Tesla is a good business and has what it takes to move on to Analysis 2.0, and second, assess Tesla's valuation. Now sit back, relax, get ready for some top-notch financial analysis, and let's make finance fun. I always start this first approach with the 5 dimensions method, where I base my analysis on 5 different pillars: growth, profitability, solvency, valuation, and dividends. These dimensions offer a comprehensive and unique perspective on a company's health. This method consists in attributing a rating on a scale of 1 to 5 to each component of these dimensions. In the end, I will average these ratings to get a final rating that assesses the company's worthiness. I won't bore you with every single metric in detail, but in the end, I'll show you the full table with the ratings. If you want further details, I post a research paper of each analysis I make in my Patreon page. You can find it in the description. First up, we've got the first dimension, growth. And let me tell you, Tesla's revenue growth is insane. In just 10 years, they went from $2 billion to $86 billion. And it doesn't seem this insane growth will be stopping anytime soon. Needless to say, I'm giving them a rating of 5 for revenue growth. We're off to a good start. Moving on to net income growth, Tesla only became profitable in 2020. However, look at the jump in profits. They jumped more than Michael Jordan in his prime. Again, without a doubt, I give a rating of 5 to net income growth. As you can see, the same happened in free cash flow growth. Tesla became cash flow positive in 2019, and since then cash flows went to the moon. Again, a rating of 5. Moving on to the second dimension, profitability. Gross margins have been somewhat inconsistent over the last 10 years, but increasing over the past 4 years, with a slight decrease in the last 12 months. This is a consequence of Tesla's recent price cuts. Now, the big question is, are these price cuts to keep the demand going or to squash the competition like a bug? My opinion? It's a flex move by Tesla, showing off their market dominance. But given the inconsistency in gross margins, I'm giving it a rating of 2. Now, operating, net income, and free cash flow margins have been following the same upward trend. After years of losses, 2019 was a turning point, and things have been looking up ever since. It's amazing how a company with 23.1% of gross margin collects 13.7% of net income margin. Master class. All of these metrics receive a rating of 5. Finally, let's have a look into return on invested capital. The current level of this metric is insane. Over 30% of ROIC. Do you know what this means, dudes? That Elon knows how to invest his money. Rating 5. So far, it's looking good for Tesla. But do you know what else looks good? That like button pressed. Do the dude a favor and smash it. Moving on to the third dimension, solvency. First up, let's talk about the debt to equity ratio. While we can say that Tesla was somewhat overleveraged over the major part of this 10-year period, since 2019, they've been killing it, with a current ratio of 0.11, which means they've got almost no debt compared to their equity. That's as solid as a rock, folks, with an equal rock-solid rating of 5. The following ratio to analyze is net debt to EBITDA, with a value of -1. What this means is a company that has more cash than debt. Rating equals 5. Finally, debt to free cash flow. The most recent value is 1.32, and translating this to English means that the cash flows that Tesla produces in a single year can almost pay off the entirety of its debt. To be more precise, to pay down its debt, Tesla would need only 1.32 years. Rating of 5. In summary, when it comes to solvency, Tesla's got it covered. Their ratios are rock solid, and they've got plenty of cash to handle their current debts. It's time to move on to the fourth dimension, valuation. Starting with enterprise value to sales, we can clearly see when the craziness occurred, 2020 and 2021. Since Tesla's valuation came down a lot when compared to 2020 and 2021, I rate this metric with a 4. The same goes for price to free cash flows and price to earnings ratios. In 2020 and 2021, these multiples were absurdly high, but they've come back down to earth over the last year. However, the 130.11x current price to free cash flow and the 46.6x current price to earnings multiples are still too high. It's not surprising for a high growth company like Tesla, but it does make the risk reward ratio a bit riskier. A rating of 3 for price to free cash flow multiple and a rating of 4 for PE multiple. All in all, Tesla's valuation is in much better shape than in 2020 and 2021. But looking solely at the current multiples, it still looks a little bit overvalued. We will have the opportunity to tackle this in the next sections. Finally, this 5D presentation ends with the not least important fifth dimension, dividends. Since Tesla doesn't pay a dividend, the metrics dividend growth, dividend yield, and payout ratio will naturally be rated 1. The only metric to be analyzed in this dimension is the number of shares outstanding. We can see clearly that Tesla's shareholders were badly diluted throughout these past 10 years. However, since 2020, the year when Tesla became profitable, these dilutions decreased immensely. I don't believe that this rate of dilution will continue over the next 10. Tesla had to finance its business when it was running on losses. Now it is cash flow positive, and they don't have this necessity anymore. Additionally, they have lots of room to increase their debt in case of need for cash. I don't believe Tesla will start buying back its shares, but if they stay shares outstanding neutral, I would be pleased. Can you hear, Elon? I give this metric a 2. Now, it's time for the summary table with every 5D component. Having concluded this 5-dimension section, we arrived at final rating of 3.84. Massive. It's thrilling analyzing businesses like this. But this isn't it. We still have lots of work ahead of us, and this is just one data point in this investment process. But before we get to the juicy part where we dive into the company's valuation, I need a favor from you. If you're having fun watching this video and learning something new, please show some love and support to the dude by doing these 4 simple things. Subscribe to the channel, smash that like button, ring that bell, and spread the word to your peeps. Okay dudes, now that you showed your love to your favorite dude, we're ready to rock and roll with this DCF valuation. First, we need to make some assumptions based on what we know from their historical data and recent trends. As such, these first assumptions will be limited, and I acknowledge that sometimes I may misjudge some assumptions due to the lack of deeper information and knowledge of the business. But that's okay because I have a backup plan, the Finance Dude's method. This method allows me to conduct additional diligence in Analysis 2.0 before making any investment decision. Obviously, this DCF valuation aims to define a range of investments rather than an exact number based on my required rate of return of 12%. As you are all aware, and despite DCF valuation being the favorite tool of most investors, it has its share of flaws, like your ex. The biggest one being that it's got more assumptions than a guy trying to slide into your DMs. We live in the information age, where we have more data than we know what to do with, but even with all that, we still can't predict the future. Alright, my dudes, let's talk about the different scenarios I consider. I establish 5 different scenarios: the base case, bull case, extreme bull case, bear case, and extreme bear case. Naturally, extreme scenarios aren't as likely to occur as the base case scenario on which most analysts agree upon. Before moving on to my assumptions, let's check the historical averages of my assumption variables in the Wall Street analysts' forecasts. I consider that the main highlights are the fact that revenues and cash flow growth are decelerating. The good news is that shares dilution is also coming to a stop. However, the price to free cash flow multiple is still way too high. A multiple above 100x in 10 years just doesn't make any sense. As far as analysts' estimates, they are projecting a compound annual growth rate over the next 3 years above 20% for both revenue and EPS growth, which I use as a proxy of cash flow growth. If we have in mind that in the next months, the economy will inevitably slow down due to Fed's hawkish policy, this isn't a bad estimate at all. A slowdown in the economy always hurts businesses like Tesla, where their product isn't absolutely indispensable for the well-being of people. Sure, almost everyone needs a car, but if we can't afford a Tesla, then we will buy a Prius. So, while there might be a slowdown in Tesla's growth in the next few years, I believe that they'll maintain these growth rates, or even surpass them, for several years to come. There are just too many upcoming drivers to consider. The continuous demand for Tesla's cars, where they sell almost every car they produce, full self-driving, full scale on semi and Cybertruck, new gigafactories openings, or the energy side of Tesla's business. It's an exciting time for Tesla, and I don't think the growth will slow down anytime soon. Enough of talk, you all want to know my assumptions. I will start by explaining my thoughts regarding the base case scenario assumptions. Then, for the other scenarios, I will be either slightly more conservative or more optimistic to reflect other possible outcomes. After this, I will attribute a probability that I believe matches the corresponding scenario. Starting with cash flow's growth forecast for the first 5 years of the projection, I chose to be a little bit more ambitious than Tesla analysts' forecasts, with a 30.0% growth rate. The cash flow growth for years 5 to 10 I chose to be slightly lower at 20.0%. There's so much a company can grow, even with so many drivers ahead of them. Moving on to another critical assumption, shares buyback, dilution. Tesla has been diluting its shareholders over the past 10 years. However, the scenario then isn't the same as the scenario now. Tesla is now cash flow positive, they don't need to issue new shares to have access to cash. That's why I conservatively chose 0.2% of yearly shares increase for the next 10 years to account for the stock-based compensation for Tesla's management and employees. Now let's look at Tesla's free cash flow margin. The highest value of free cash flow margin Tesla had was 7.4% in 2022. I think that this margin will be compressed over the next couple of years for the reasons explained before, but I believe Tesla will manage to achieve a margin of at least 10.0%, 10 years from now. To finalize the base case assumptions, I need to define a price to free cash flow. Tesla's current multiple is 126.6x is quite high and unacceptable to expect such a multiple 10 years from now. I always choose to be more conservative because, in the longer term, growth will decline, margins will stabilize, and multiples will reflect that scenario. That's why I will choose for Tesla a price to free cash flow multiple of 20.0x. Here are the remaining assumptions for the other scenarios. After running the DCF model for each scenario, I obtained the following results, starting with the base case. In order to have my 12.0% required rate of return, if we believe that these assumptions will be met, then we should pay $101.36, a minus 34.1% downside from its current price. A big difference between the current price and the estimated price. You may think that it's impossible to buy Tesla at these levels. In fact, on January 6, 2023, Tesla was trading at this price. But would you have bought it? Tesla's stock was a falling knife back then. That's why it's important to keep our analyses up to date in the levels where we feel comfortable to buy a stock. Otherwise, if we pay the current price of $153.75, the implied IRR would be 6.1% per year. The risk-free rate is currently around 5%. Not the best trade-off. My base case scenario implies that Tesla would have yearly cash flows 10 years from now of around $39 billion in revenues around $390 billion, which represent 4.5x the current revenues and a 16% compound annual growth rate. Now I'm curious, do you think Tesla has what it takes to 4x its revenues over the next 10 years? Let me know down in the comments. Moving on to the bull case. If we believe that my assumptions for this scenario will happen, we should pay up to $182.40, a 18.6% upside from its current price. This implies an IRR of 13.3%, above my required rate of return of 12%. Nice. But this scenario isn't as likely as the base case. It requires many variables to fall in place. Variables such as attaining full autonomy in driving, robot taxis, and many others. Achieving a revenue of $500 billion isn't easy. At an average price of $40,000, it would mean that Tesla needs to sell 13 million cars a year. Impossible? Toyota, the automaker that sells the most cars worldwide, sells around 10 million cars each year. Though not impossible, it will be extremely difficult to reach. Tesla only sold 1.3 million cars in 2022. In the bear case, these assumptions indicate that we should pay $36.71 to have a 12% rate of return each year, a minus 76.1% downside. More than half the current price. Although I'm confident that the assumptions for this scenario are too conservative, they can indeed happen. We may face a recession and people start to struggle and start to cut on their spending. Moving now to the extreme cases. Starting with the extreme bull case. In this scenario, I assumed everything goes perfectly like a fairy tale. Tesla's cash flows growing at 50% a year, like Elon Musk repeated several times. Tesla starts to buy back its shares. Margins grow to 14%. Everything is perfect. Is this possible? I don't think so, it's highly unlikely. Generally, these extreme scenarios only account with a probability of 0.5 to 1%, negligible. If by some miracle, this scenario comes to life, we would have a 30.4% annual return if we bought the stock at its current price. Bonkers. Aha, you wish. In the other extreme scenario, we're looking at almost a 90% drawback in 10 years. While this may seem far-fetched, it's not unprecedented, and we've already seen Tesla stock drop 75% from all-time highs at $414.50 to the January lows of $101.81. So, it's always important to keep a close eye on valuations and not just blindly follow the hype. Even now, after this crash, my base case indicates that the stock is overvalued. Now, keep in mind that these assumptions are just a first gauge of Tesla's valuation and don't incorporate qualitative information from more advanced analyses such as Analysis 2.0. Before making any investment decision, I would need to stress these assumptions. But for now, I hope this gives you a good idea of where Tesla stands in terms of valuation. This is the summary table with all the scenarios' price targets and probabilities. The probabilities that I think best reflect the scenarios I made are 60% for base case, 24% for bull case, 14.5% for bear case, 1% for extreme bull case, and 0.5% for extreme bear case. Using these probabilities, I weighed each scenario's present value by its probability, which led me to a final price target of $117.45, representing a nasty downside of minus 23.6%, indicating signs of overvaluation. As you can see from the graph, the stock is currently trading near the estimated price of the bull case. Ideally, we'd want to buy below the red areas shown in the graph. In fact, we got really close last January. We shall look further to the multiple valuation to confirm this first results. To get a fair price for a company, we gotta compare its current multiple to its 5 and 10-year averages. You can easily notice that the 5 and 10-year averages have some unrealistic multiples, and it wouldn't be honest to consider them. That's why I considered more reasonable ratings myself and not the 5 and 10-year averages. Averaging all the prices that resulted from the manual selection of each multiple, we obtain a price per share of $105.56, a nasty downside of minus 31.3% and close to the DCF valuation. What these valuations are telling us is that the fair price for Tesla stock would be around $100. Both are indicating an overvaluation of Tesla's between 20 to 30%. It's time to wrap up the first analysis of Tesla's business by comparing the three different data points: 5 dimensions, DCF valuation, and multiple valuation. One of our missions for today was to assess whether Tesla is a good business and has what it takes to move on to Analysis 2.0. Well, the 5 dimensions revealed an outstanding business, with a final rating of 3.8. Tesla excels particularly in the growth, profitability, and solvency dimensions, and the only one that lags is the dividends dimension, which is understandable. Tesla's priority is to grow and reinvest all its cash flows into the business. That's why we shouldn't be worried with this dimension for now. And we can't complain about that, as those reinvestments have been productive, as evidenced by the 30.5% ROIC. Amazing. Even though Tesla's 5 dimensions rock, we can't say the same when we value the company. The other mission we had was to assess Tesla's valuation, and its stock looks somewhat overvalued, and I'd personally be more comfortable investing at lower levels. All this considered, it's time for my final verdict. Tesla will go to the next round and there will be an Analysis 2.0. Despite showing signs of overvaluation, I have to conduct a thorough analysis of the business. I need to try to understand what the market is viewing before making a final decision. Perhaps they are anticipating higher growth and higher margins than I am. Perhaps I'm not seeing the full picture and all the growth drivers that Tesla has. That's why I must deep dive into this business. If you can't wait for this second analysis, don't forget to subscribe to the channel and turn the bell on so you receive the notification once I post the video. Thanks for watching, and I'd love to hear your thoughts on Tesla's business. Do you think my assumptions were reasonable, or was I too conservative or too optimistic? Do you have any suggestions to help me improve my analysis process? And what are the next stocks you would like to be analyzed here? Let me know everything down in the comments. Together we can make a difference. Peace, dudes. You rock.